I'm Jon Marino with The Deal. We're here at ACG New York's Manufacturing and Logistics Conference. I'm joined by Jeff McLane of Bank of America Business Capital. Jeff, why don't you tell us a little bit about what you folks have been doing and what you've been seeing in the industry lately?
Good. Well, thank you. Thank you, John. It's good to be here. We've actually been very active in the market this year. If you look at the amount of new deals, and we finance companies in the middle market, a lot of manufacturing, logistics, a lot of industrial companies. We finance companies that range from being 50, that have 50 million of sales to all the way up to 20 billion of sales. We do finance a lot of companies that are 50 million to 2 billion of sales. And so we've been very active. We see a lot of financing needs versus same time last year. We've seen a lot more deal activity, and manufacturing companies are very active.
All right. It seems to me like, I guess, debt has gotten a little bit cheaper. It's been kind of an advantage for strategic companies. How is private equity kind of factored in against them, so to speak?
Sure. Well, certainly strategics have a little, are sitting on historically record levels of cash right now. And so in M&A situations, they have a bit of an advantage because they're going to look at the alternative use of that cash, whether it's parking it at probably low interest rates, or if they can make an acquisition, get a higher return on that capital. Notwithstanding, private equity firms, they have a lot of access to capital right now, whether it's asset-based lending, cash flow lending, institutional term B, or high yield bonds. Those markets are very much open and active, and they have access to those in terms of financing acquisitions. And the private equity firms, notwithstanding the strategics may in some cases have a competitive advantage with record levels of cash, when a private equity firm is interested, when they really like a company, they can win. We financed a company just recently, a private equity firm that was buying a company that they paid over 10 times EBITDA for that company. When they want it, they can be competitive. So,
what kind of financing activities are you seeing a little bit more broadly, maybe outside of M&A in the manufacturing space?
Well, certainly, asset-based lending is very active. Cash flow lending, that's pro rata cash flow lending, very active. Term loan B, which is the institutional market, and high yield bonds. I would say institutional term loan B and high yield bonds is certainly more active for a little bit larger companies, companies that have $50 to $75 million in EBITDA and greater. But all of those markets are very active right now. Now, I would say in Europe, the other market for really middle market companies that's more active is the factoring business. You don't see that as common in the US, but in Europe, that's a much more common market for middle market companies.
I like that you touched on Europe. Can you spend a little bit more time maybe talking about some other global, maybe macro factors that are kind of going to impact the manufacturing industry and PE activity here in the US?
Well, sure. I have spent time recently in France, in Italy, in the UK in the last couple of months. And one thing I come out as saying is I feel very good about the US. So, but I do think US companies are and the manufacturing companies are very well positioned. And one thing that I certainly think, and this is just my view, is that they will have a competitive advantage over the next 10, 15, 20 years in the form of low-cost energy and lower-cost energy. I think that will be a real advantage for U.S. manufacturing over the next 10 plus years. I think of that as a factor.
All right. You had mentioned asset-based lending earlier. What else, I guess, are companies using in terms of credit?
Well, they're using asset-based lending. They're using cash flow lending. Two areas that we at Bank of America are very active in, both for middle market companies to large corporate companies, but also other forms, supply chain finance. We're very active in that, helping them finance their supply chain and that can benefit them when our clients or borrowers have a stronger credit profile than some of their vendors that can't borrow as cheaply. And those supply chain arrangements can help their vendors get lower cost capital.
All right, one more question while we've still got you.
Sure.
You mentioned a recent deal you had worked on that I guess came out to about a 10x EBITDA for the buyer. Where, I guess more broadly, are you seeing multiples in the sector? And also, where is that from, where we were 12, 24 months ago?
Well, you know, interesting. We just did our CFO Outlook, which we do every year. We've actually done it for 15 years now. We survey a lot of CFOs in our commercial banking business that are our clients. And a data point that I would offer is that just over half would say that they haven't seen prices go up over the last year. And about a third of them would say they don't expect them to go up in the year ahead. So it's hard to pinpoint exactly where we're seeing multiples because every situation is different. But broadly speaking, that would be my view.
All right. Thank you very much for joining us today.